Well, look, first of all, I think the first question you posed in my mind is absolutely the crucial question, because everyone, and it's not only in the US, everyone over here in Europe as well, is talking about a relatively deep but short-lived crisis. And if we do that, we can patch it over. And as we just heard from Bullard, the package is worth around about 2.5 months worth of US GDP. So if you can sort of sustain the economy over that period of time, and then you snap back, then I guess all of these people who are currently being unemployed are also going to be brought back into employment relatively quickly. However, having said that, the length and the duration of this crisis, that's the absolutely key component here.
Peter, good morning to you from London Bridge Station. Is there a difference between the economic bounce back and the financial markets bounce back? Of course, huge criticism about the last huge financial crisis, about how the markets were given all the fuel to go higher, to record after record, but actually large parts of the economy were left behind. Is there a difference in the stimulus this time round, which will mean the market performance is going to be different from the economic performance?
Well, first of all, yes, certainly there is a difference. I mean, when you just look at where the epicenter of the crisis is, it's in the corporate sector now, and obviously in the hospital sector, but in the corporate sector economically, whereas previously it was in the financial sector. The financial sector is actually reasonably fine, and one could say with a little bit tongue in cheek, we could thank for the financial crisis there was, because now we have a lot of the tools and we have a much more stable banking system. But so therefore, clearly it is different. For financial markets, I think we'll have to see. I mean, I think what the politicians and the central banks have done now is they have prevented a systemic collapse, and particularly they have prevented large-scale defaults on a relatively quick scale. So therefore, particularly the higher-rated names in the credit sector, I think now should be starting to perform a little bit better. However, that does not mean that we're creating a lot of earnings relatively quickly. Again, that depends crucially on how long this hunkering down period will be.
Peter, do you think that the market fully appreciates the Federal Reserve's recent moves? Because I was looking at some estimates when you pair the new relief package from the Senate with what the Federal Reserve has announced, we could be looking at trillions of dollars worth of support for affected industries, not just the $75 billion that was announced yesterday.
Well, look, yes, but I do think that the market has realized quite clearly what both actors are doing. I mean, first of all, when you look at it, what the Federal Reserve is doing is first is keeping the banking system hyper-liquid. And that's not only the US financial system, it's also the international system. We've seen that with the swap lines and all the rest of it. Secondly, however, what the Federal Reserve is also doing is trying to bypass the banking system and go directly to the affected corporates. And we see that in the CP program. We now see it in the primary and the secondary credit facility that they rolled out, and in the yet to be finalized program for Main Street, where they're trying to reach SMEs. So they're trying to do their best to keep these companies liquid. And the same goes for the government. They're trying to do something for the individuals that are impacted by this, but also for the corporations, and trying to give them loans and trying to give them guarantees and all the rest of it. But again, none of these measures can address the underlying fundamental problem. If the situation is much longer than we think, and if it might potentially impair some of the business models that are around in certain industries, all the support in the world is not going to change that.
And yet there are companies that are still managing to raise money at this point, Peter, and that's the tell, I think, on just how this liquidity freeze has eased up as a result of all the stimulus that Juliana was mentioning here. My question would be, actually, at what point do the authorities have to suggest to some of these corporates that they don't continue issuing paper and that we don't actually see continued dividend payments and buybacks at this stage? As I look at the numbers, $63 billion worth of investment-grade corporate issuance came to market this week. That doesn't suggest that there is a problem with liquidity right now.
Well, but look, this is exactly what is required. When you think about it, most of these corporates, as we heard in your earlier sound clips, most of these corporates have a significant problem with their revenues. So the revenues are falling away. So they need to bridge that somehow. So they need to raise capital. And one of the good things is that through the transaction, and I think particularly the primary credit facility is very advantageous here and will give us the ability to do that. I mean, if we turn that question around, how would the market look if there was no access to credit for these corporations? That would be even more devastating than what we already have.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.